rule of money that we're going to be going over today in honor of Life Insurance Awareness Month is the DIME method. Now, before we dive into this quiz question, what do Tim Cook, who's the CEO of Apple, and Danica Patrick, the race car driver, female race car driver, what do they have in common? What do they have in common? It's probably very odd to think of that. Danica Patrick and Tim Cook, the CEO of Apple, well, both of them got up in front of large crowds yesterday and gave a presentation. One of them gave a presentation announcing the new iPhone XS, XS Max, and XR or something like that, and got up in front of people and talked about spending money. And all the people in the crowd got super excited, and they looked at their bank account, and they saw that, you know, the new iPhone starts at about $800, or if they got on a payment plan, it started as little as $36, I think was the lowest, $35 or $36 a month to buy a device that they would put in their pocket that then they need insurance on and a whole bunch of other things. And what does that have to do with Danica Patrick? Well, Danica Patrick is the official spokesperson for Life Insurance Awareness Month, and she also gave a presentation yesterday in front of a lot of people about life insurance. And depending on their age and their health, the majority or a lot of the people in the room, for the same price or less that people are trying to justify in every way, shape, and form to buy the new iPhone that they're going to pay $36 or $39 a month for, they could get life insurance that protects their family for less per month. One is encouraging us to spend money. One is encouraging us to protect our family. And so just an interesting thing that both of those events happened yesterday. Two different events, two different speakers in front of people speaking about something, encouraging them to do something, one to change their life and one to buy an electronic device. Yet more people will spend money on an iPhone this year than they'll spend protecting their family. So think about that as you go throughout the next days and next few days, and maybe that is a way to bring up a conversation with somebody as you're talking to them. So this real world rule of money, the DIME method. The DIME method is a way, not the only way, but one of the best ways, in my opinion, to determine the need that somebody has for life insurance. And DIME, D-I-M-E, stands for debt, income, mortgage, and education. Debt, income, mortgage, and education. So this is a method of determining what type of life insurance coverage somebody needs total. And the way to do that is you take your debt, and that's going to be credit cards, cars, student loans, personal loans, any debt that's not your mortgage, and you would write it down on a piece of paper. So write down a number, what all of that adds up to be. Then take your income, multiply it by 10, and write down whatever that number is. Write down your mortgage balance in the M category, and then whether you believe in helping your kids with college or not, or you want to or not, that's what E stands for, which is education. Calculate, I've got 4 kids, I want to give them each $20,000 towards their education if something were to happen to me, so that's going to be $80,000 in that column. So to give a real-world example of why this is so important, and this principle is going to maybe go a little over 5 minutes, but let's jump to the board. So we look at this at the DIME method. Okay, so let's take me for example. Okay, we'll take me for example. So if well, maybe I'm not the best example. Let's take someone that I met with yesterday. Okay, let's take their total debt. They just have one car, and they had a few credit cards, and they still had a student loan that they had from a while ago. But their total debt added up to be about $40,000 outside of their mortgage. their income, I would be really boring on this in all the columns. So we'll use somebody that kind of, I would say, you know, the typical person that we're gonna run across. So I stands for income, and they made about $65,000 a year. So in the I, it's their income times 10. So in this column, it would be, or row, I guess it would be $650,000. M, they owe 260 something, 68, 62. I don't know. Let's say 62. 260 for math reasons. Let's keep it simple. 260,000, and then E, education funds for kids. They said if something were to happen to them, they would like to be able to leave their kids around $20,000 each. So they've got 3 kids. So 2, 4, 60, right? 60,000 total there. Okay. So how do we do the math? We just add these numbers up, and that's going to be the total need for insurance. So that's going to be 9, 15, 10, 15, so 21, 4, so $1 million, right? I don't know. I guess I should have done that. That's 300,000 together, 950 plus 60. So yeah, 1,100,000. Okay, 1,100,000. So a lot of the time, people see this number, they say, "Wow, that seems like a lot. That seems like a lot." Well, a lot compared to what is what I always think. But here's the question: once somebody walks through this, the question is, if this seems like a lot, which of these things would I like to not take care of if I were to pass away? Which of them would I leave off? So let's give an example. This husband is the primary wage earner. His wife stays home with 3 kids. Let's say he was to pass away now, because isn't that the point of having life insurance? It's not how much does it cost when I'm alive or how much coverage do I have while I'm alive. It's what is it going to do if I was to pass away. Well, when I would pass away. Nobody gets out of here alive. So he passes away. His wife would be in a position to pay off all of that debt. Well, just the payments on his debt are almost $600 a month. So that's $600 a month she doesn't have to come up with anymore. $650,000, let's just set that aside for a second, and we'll come back to that. And that's to replace his income, $650,000. The mortgage is now paid off. No more mortgage payment, and their mortgage payment is about $1,500 a month. So there's a total of $2,100 of payments she won't have anymore if something happened to him, if he's properly protected. And then now $20,000 each has been set aside in a little account for each of their kids. So when the day comes to go to college, they'll be able to reach into these funds and help the kids pay for college. So you run through that and you ask this family, if something were to happen to you, do you not want to pay off the mortgage, not want to pay off the debt, not want to provide the education funds for kids? But then here's the best part. And this kind of mixes into 2 different parts of planning, is insurance planning with the right type of savings planning. Because if this was put into some sort of investment or some kind of account that could grow, if this was earning 7% per year, that's the equivalent of about $45,000 a year of income. Well, does that replace his income? No, it doesn't. But look at this. If they're making $65,000 a year now, with a house payment, with debt payments, and they're able to make it, could she live on $45,000 a year with no mortgage payment and no debt payment? Because you think about it, the difference between the $65,000 a year and the $45,000 a year is $20,000. Is she spending more or less than $20,000 a year on those two payments? And the answer is, of course she is. She's spending more than $24,000 a year on the debt payments. She gets a pay raise, and how long would that last? For as long as that earns 7%. That is proper protection in insurance. So what's the alternative? The alternative is what the average death benefit paid out last year in the United States was about $170,000. So let's run that through the scenario. So here's alternate universe. She has the typical coverage through the husband's work. He passes away. She gets $170,000. Does that even pay off the mortgage? No. And then what does she do? In this lady's case, it's kind of a younger family. She has to figure out what she's going to do for income while someone else raises their kids. And I don't know what they're going to decide to do, but based on what they said and what their faces look like, they want to make sure they have proper protection and insurance. Now, in your 30s, as we talked about on episode number 1, you get a level term policy that's $1.1 million in your 30s, and you're looking at maybe somewhere between $50 and $70 a month, right? And so for the price of the biggest iPhone, it's like 500 and something gig or something crazy. That payment's going to be about $70 a month to get the new iPhone 10s Max or 10X Max or whatever it's called. I don't even know. $70 a month for a $1,000 device, or pay less or maybe the same for $1 million of coverage for 30 years, right? But who's more passionate about what they're talking about? Tim Cook about the iPhone and why people need that, or life insurance? So there is our real world rule of money today is, one, is people need to analyze themselves what coverage they have, and is it enough, and is it going to provide for what it's supposed to provide? And anybody that's in the industry can have this conversation with clients and make sure that they're properly protected. So, the DIME method. Very cool.